can use tokens to align and drive value with their community. Um, our belief is that this stuff is really, really early. We started seeing this crazy wave of interest through NFTs in the last month, 2 weeks specifically. My life has gotten ridiculously crazy, and I think underneath all of that is still this really experimental, not super clear, whole bunch of questions, not a bunch of answers type thing. And that's really the place that Seed Club has been playing and will continue to play over the next months and years. So I think like the answer is that we don't know to these questions really. Like I think that's the fair answer. But there's like a lot of really great experiments that are happening, and I think we're starting to see some templates emerge that are at least allowing us to allowing more communities and creators to get their hands dirty and play around with some of these things. So like our core belief is that there's value in coming together on the internet, and that value is not captured by the creators and the communities that are doing the work. And we see a ton of value in tokens as being like a really low friction, super extendable, programmable, fun way to align those incentives. And we're seeing all sorts of different experiments, whether it's social tokens for access, like Friends with Benefits, that creates a really lightweight DAO where you feel ownership in participating, and you sort of have aligned interests at the organization level, with some really interesting ways of actually distributing value within the community using tools like SourceCred, all the way through to these sort of like creator centric collectives that are emerging around art collections, like Tech Optimist, or some of the individual creators like Justin and John Gold, just using tokens as a way of bringing community together and then ultimately giving them a bit of ownership in these things. And then of course, like the experiments that I think Patrick will talk about later are also super interesting. So I think the things that we think about often are really just, how do we get value up and build community before we start to introduce things like financial rewards? Because you're 100% right, the intrinsic piece there is something that needs to be thought of deeply. um, there's this great tweet a while back about the Sushi Swap team, who's one of the big automated market makers, decentralized exchange in the crypto space, um, having tens of thousands of followers, hundreds of millions of dollars in market cap, and not feeling like they had a community, because it was really hard to get things done. And I think the introduction of pure financial rewards at the beginning is completely unhelpful in trying to actually build meaningful connections with people. So I don't know, I feel like I'm ranting here quite a bit. Happy to get into like specifics of our experiments as if you have more questions moving forward. But
Yeah, I'm curious. You mentioned just FWB, which for people who don't know it here, it's basically a gated access community where you have to buy this token in order to gain access. And the idea is that the token appreciates in value, and so the earlier you are part of this community, the more kind of you benefit from that upside. One kind of challenge I see there is, for these communities is, first of all, there's this kind of implicit obligation to make the token more valuable over time, and so you're kind of like trying to operate like a public company that's constantly monitoring its stock, and maybe you could push back on that. And then the other piece is, the idea there that it's tokenized access, it just means that it's more expensive for people to join over time. And so, there's some tension there with kind of the democratized access, like how, if somebody's building, say, a subscription product, a membership product, what can we learn from that? Can, if instead of paying for a membership to read a newsletter, can we buy a token? And what does it mean when that token rises in value and then it's not accessible? What am I missing here?
yeah, so I think like token gated access is like it's a new model, right? So it's probably going to be best applied with other revenue models. So I see like token gated access along with subscription probably being one of the ideal pairings there. The downside of token gated access is you're not really generating revenue through selling these tokens. It's you're not paying a monthly fee in tokens to access. You're just holding tokens. You can sell those tokens in the future, and so it's sort of like a useful in getting a sense of ownership over a community, not super useful as far as generating revenue into a community. We're seeing NFTs kind of play that role in these communities now, and I think when NFTs sort of evolve more into like royalty and revenue sources themselves beyond just like the initial sale, I think that gets pretty interesting. I think there's like the friction is really that these communities aren't trying to grow as big as possible, really. I think like the idea that the fear that I see in many of the community leaders that are running these projects is how do we create value as this thing scales. And so I think price in many ways actually is a benefit to them, in that it starts to sort of it gets early people on board. There's definitely a sort of a speculative nature to it as people try to capture on the upside. Though they have some plans, Friends with Benefits does a seasons program where there's sort of an increasing price to actually get in that reduces that for people who are active within the community, they get rewarded with enough tokens to sort of not have to buy new tokens to access that higher level in the next season, and others will have to sort of pay up if they're not actually creating value in the community. So I think there's some interesting dynamics there. And then the question of how do you bring people on who you actually want to have in your community that are going to create value. I think you see these organizations start to run out grants programs and to be using their balance sheet as a way of sort of like sponsoring people to join. And so it becomes an organization that's not about growing your Facebook group to 10, 50, and 100,000 members. It's about getting the right 500 to 1,000 people in there that are creating value on a regular basis. And you can be a lot more discerning, I guess, once you have as the price starts to raise.
Yeah, it's interesting. So, you've spent a lot of time on social tokens. I'd be curious, Joris, if you can introduce yourself. You have taken the position that social tokens are not, one of the challenges is that they're not regulatory compliant. And so maybe, walk us through what Fairmint does. I know you're kind of a few months into launching this. What have been some of the more interesting implementations you've done? And yeah, I guess what's your opinion on social tokens? Since we last spoke, it's been a while.
Yeah, sure. Thanks, Sari, for having me tonight to talk about Fairmint and what we do. So just to give you a bit of context, so I'm an entrepreneur since more than 15 years now. In my first businesses, I had more than 500 employees, and I had to deal with all the problematics between paying them and also letting them participate in the upside of success. That was 13, 14 years ago. And that was a failure because at that time I couldn't find anything that would literally align all of those people with the success that we were getting as founders of the company. And during the last 10 years, I've been considering this idea that stakeholder capitalism should be the right way, the new upgrade of capitalism, compared to what exists today, which is a shareholder type of capitalism. And to directly dive on the social token versus the rest of securities or currencies token. Well, I think it mostly will change the way people get incomes. To put something in the fridge, when to get wealthier, building their wealth, probably that will depend on the upside that they can capture thanks to securities. And when we decided to work on Fairmint with Thibault, my co-founder, 2 years and a half ago, the goal was really like counteracting inequalities by decentralizing access to wealth. And the way we saw that was that private companies today are literally preventing 99% of the population to access to the upside that they are building. And if we imagine Uber starting in 2021, we couldn't imagine 1 second that the first Black limo driver wouldn't get a share of a piece of the upside. And that's what happened 15 years ago when Uber started, or 14 years ago. And that is something that wouldn't be expected in 2021, because we with crypto have the opportunity of our generation to literally change the way things are working by decentralizing completely the access to the upside, by making sure that all those stakeholders will participate on opportunities that are traditionally reserved to insiders. And I think one of the major upgrade here will rely on the rise of the everyone stock ownership plan that will replace the employee stock ownership plan. And we saw in term sheets of VCs 30 years ago, 40 years ago, the need of an ESOP for employees to retain talent. today building your company relying on a strong community will be, if you start this type of ownership and you start to distribute the upside, literally you are building one of the best competitive advantage. You are doing it fully compliantly, and you are aligning for the first time all those people with the founder on the financial upside, which is the major challenge that we wanted to work on with Fermi. And social token, I see a true way of using them, but more on incomes, making sure that everyone would get an income that today they wouldn't get, and that since probably 10 years, some people were working for free on many communities. And today, thanks to these new tools, they will be able to get an income. But at the end, the true upside that they want to capture has to be closer to what exists with securities. And so I think in parallel we will see the two movements. One that is way easier. You go on a platform, you mint your social tokens, and you start to drop millions. But the value on probably 80 or 75% of all those tokens, sorry, might not be there at the end. When you start to deal with securities, obviously the friction to start is probably way higher. But at the end, you know that the underlying assets of those type of securities will be there because it points to the equity of companies. And just a note on Fermi, so for people that don't know what we do, so basically we allow any company to make their equity programmable. They can put an invest now button on their website, and they can start to issue securities that will be fully branded directly from their website and with their own ticker symbol. And thanks to that, the ownership in these companies will be pretty easy, either by investing or by earning, being compensated for any service that would be provided to the company itself. And you can find us on fairmint.co.
Joris, one of the most interesting things about Fairmint is that although it operates on crypto rails, that's, you've kind of stayed away from using any kind of, cryptic terminology on your website. It's very easy to understand what you do, but there's still, this space is so nascent. There's still very few kind of templates or examples or clear benchmarks to follow. Even if I decided to reward my contributors, how much, when, based on performance or based on seasons, or there's so many ways to do this. I'm curious if you can share, perhaps anonymized data on who is finding this most valuable. Do you feel that this might be going mainstream anytime soon? Is there a technical or a user experience leapfrog that still needs to happen for this stuff to be adopted? Here's what you've learned in the last kind of few months of being operational.
Yeah, well, the compensation is clearly a way for people to access the upside. And what was key in what we are building is probably to denominate everything in dollar, to make sure that what people would hold would be clearly something that has a true value based on the fair market value of the companies. And rather than to just issue and then put the things on the secondary market where basically people would start to trade and would set a valuation that might not be relevant here. We keep the opportunity to always issue from the primary market that finances the company as well. Now to answer your question about some kind of pattern, I would say that we have a lot behind us, like all the loyalty type of program that existed. And one of the major issue was that it was most of the time not in cash, not easily tradable or redeemable. And one of the other points was we wanted to make the friction that exists today in dropping securities pretty simple. So what we start to see right now is basically companies working on a set of actions, and those actions would be valued in dollar. And when a person would make an action, then automatically this person will receive an email saying, hey, you can go and redeem your X dollar on invest.acme.corp. And at the end, when obviously all the legal would be ready, that would be when the person would be able to receive the securities of the company, the dollar Acme, for the amount of dollar that she could redeem. And then obviously, what we start to see is a clear work on what would be the tax treatment for that. Like, do we choose options with a cliff vesting, or do we stick to the cafe form of RSU, or do we give securities directly? And all those questions are currently on the table. What we start to see is the facility for all the founders that wants to do that to use the option. And clearly, what was broken on the equity world since a while. I don't know if you read a post from Steve Blank on how the stock options are broken that he wrote 2 years ago, but I can share a link right after. I think it's very interesting to see how this options model got broken due to the illiquidity of the options, and that's why we started to see so many secondary market for employees stock option to be sold before that the company would run an IPO. And and the fact that we offer the opportunity of liquidity on our own layer on those special securities, it offers also a way for all those people that receives option to first monitor in dollar what are they holding permanently, but also as soon as the vesting would be over, they will have the opportunity to redeem for cash. And that was one of the major feedback from the stakeholders that we interviewed when they were considering of having and holding something, getting an ownership in a company. They didn't want to have something where they have no idea of the fair market value live, and where basically they would be locked without knowing how much they would get at the end. And the fact that we can offer that on their dashboard permanently, they can connect every day and check if the value grow or not. And as soon as they want to sell because the cliff and betting are done, then they can go and sell. So that's what we start to see clearly. We are still super early on this part, but the API that we built is made so that tomorrow large community will be able to receive all those type of securities super easily, and to solve the issue for the founders when they decide to go on this path, because obviously the UX was absolutely key. You mentioned it at the beginning, but yeah, UX is clearly one of the major challenges in this type of world.
Yeah, I want to give Patrick a chance to introduce himself and the work that you're doing at Mirror. I'll share the link in the chat, but Mirror is an example of user ownership in action. And so, Patrick, why don't you introduce yourself and walk us through what Mirror is doing, how you're approaching user ownership, what is this right token, how does it work, and yeah, share your thoughts on this space. Welcome.
Yeah, thank you. First few slides blew my mind, and yeah, love the way you think about this stuff and explain it in a really simple way to understand. And I know if a few people in the community are here on the call, this is the awesome forum that you have, and so thank you for inviting me. So yeah, I recently joined Mirror. I worked with one of the early engineers there and saw what they were working on. Saw the first experiment that they ran around crowdfunding an essay, and thought that was super interesting. The more I dug into it, I realized that yeah, it's still quite early, but I think that a lot of the ideas here are just frankly quite mind blowing once you really take a step back and think about it. So the way I like to think about tokens specifically is that they're really just another product that you have as a company. And so, but the main difference is that usually with a product, it's just software. And so that maybe it's an app, mobile app, web app, maybe it's just a feature within an app. But I think the same frameworks around finding product market fit, iterating, talking to customers, things like that still apply for a token. But the main difference with the token is that it has economics embedded within it. And so it's a financial asset. And so depending on how it's structured and how it's programmed, you can trade it on an open decentralized exchange like Uniswap. You can hold it and it can appreciate in value, or you can do other things, or you can have like rights to royalty shares or something like that. And so tokens, the way I think about it, is just software plus like a financial asset, and try to view it as a product. And so given that it's a product, I think it depends on, and the way I like to think about it is that there's protocols that can have tokens, and then second, there's creators that can have tokens, and they kind of look at it a bit differently. And so for protocols, there's also like two different types that I like to think about. One is DeFi protocols. The other one is more like NFT creator protocols. And there's tons of other ones, but those are the two main ones that I've been looking at and studying, and that have been most popular recently. And so, depending on which type of protocol you are, there's like three main kind of benefits of tokens. One is yield, or just return, like on the financial asset. Second is governance, and so having a right to vote on different decisions. And then third is access. So if you hold this token, you get the ability to do something. And so if you're a DeFi protocol, we've seen that yield is like the main reason why people are using these different DeFi protocols. And so they do this thing called liquidity mining, where they basically say, hey, if you deposit funds into our DeFi protocol, we will give you our token. And then our token is going to become more valuable because more people put tokens in this protocol. And so by you getting these free tokens, then you're basically going to make more money by using our protocol instead of another one. And so that ended up blowing up DeFi this past summer. And that's kind of like one of the strategies. But once everybody has these liquidity mining schemes, it becomes less important. And so that's the way I look at it for on the DeFi side. Then next after yield is probably governance. And so you can use it as a way of deciding how much in fees should be applied, and which new tokens or what type of features should be added to the protocol. And then lastly is access. Most of the time, DeFi protocols are open access, and so that one's not as relevant. But in terms of like NFT protocols, and specifically at Mirror, we kind of flip it where access is most important. Or we use the token for access, and then second for governance, and then third for yield. And the reason is because for an NFT protocol, we try and focus on product market fit before we try and add any sort of financial incentives, because similar to many like Web2 products or normal products, you don't want necessarily add a referral program if you're not retaining customers. You have what's known as the leaky bucket. And so it ends up you're paying a bunch of money for people to refer their friends, but they don't stay on the platform, which increases customer acquisition costs and has a lower lifetime value, which ends up becoming pretty hard on unit economics over time. And so for us, the way that we're looking at it, since we're not a purely DeFi protocol, we want to use our token first as access. And so we have this thing called the right token. And if you hold one right token in an Ethereum address, then you are able to burn the token, or basically just send it to an address that can't be recovered, and then you get access to the platform. And yeah, we like doing that because then we can layer in governance to be able to decide who gets that right token. And so every week at Wednesday at 3 Eastern, we do something called the right race. And we have this mechanism where if you connect your Twitter account, you get 10 votes, and then you get to basically distribute those 10 votes to anybody else that has connected their Twitter account. And then if you're an existing member, you get 1,000 votes, and each week you get 10 more votes. And so we kind of weighted so existing members get more say, because they're the ones most affected by people being onboarded onto the platform. And so we use that as a governance mechanism, and that's another way to use tokens. And then yield is the third one. And so eventually, once we kind of figure out product market fit, and hopefully, and then we can layer on more economic incentives into the platform. And then the last note I'll say is, so in terms of, so that was around the protocols and how I've seen protocols think about tokens. And then the other way is for creators to view tokens. And so specifically on Mirror, we've run a few experiments now, and I think the three main ways we've seen so far are using tokens as a financing mechanism. And so that's through our crowdfunding feature. And so the main difference between using Ethereum to crowdfund instead of Kickstarter is that you can do a global permissionless crowdfund. And so anybody in the world with an Ethereum address can participate in the crowdfund, as opposed to existing solutions like Kickstarter and AngelList, where there's accredited investor laws, there's regulation. And I do think that the laws and regulation are important for consumer protection. And so I don't think it should be like the wild, wild west. And I think there is like a balance there. But I think that, experimenting in these ways is going to provide access for people in certain regions, or just certain backgrounds that may not be possible today. And so financing is one way to use tokens. Another way is through monetizing superfans through NFTs. And so now you can have a one of one NFT, and then someone can pay 5,000, 10,000, $15,000 to have ownership over that asset. We can go deeper into that. And then a third way that we're just starting to explore is sharing revenue. And so we're actually collaborating with Jess and one of the creators that he knows around using tokens as a way to write an essay and then share revenue with people that contributed on that essay. And so you mint the essay as an NFT, and then every sale of the NFT, you share some of it with some list of contributors. And then the last way creators can use it as a form of governance. And so that's around things like voting on certain ways to use a community, certain ways to onboard people, certain features you should add, and things of that nature. And so that's kind of the way that I think about it from like tokens are a product, and then from the protocol level, whether your DeFi protocol, NFT protocol, then also for creators, some different ways that we've seen on Mirror how it's used.
Yeah, that was excellent, Patrick. Yeah, I'm curious, before I open it up here to the audience for questions and discussion. So on your last point, my understanding is there's some kind of legal issues around guaranteeing revenue as part of ownership with tokens. So
Mm,
I'd be curious if you can expand on that with that last point. And then, yeah, you mentioned yields, governance, access. I do love Mirror's approach of starting with access, and I imagine eventually the right token will be tradable on Uniswap, and there's some upside, but at least the incentives don't feel overly financialized initially, which is great. But yeah, I'm curious on that last point, if there's anything you can comment, and then my other point, and you can all feel free to chime in, is you mentioned this like global permissionless crowdfund. Um, but this kind of permissionless crowdfund still feels like it's global, but really restricted to crypto people. And the universe of people that have an Ethereum wallet, that have a MetaMask wallet, that are kind of comfortable, able to transact, still feels limited. And I'm curious if you all can share thoughts on whether that's kind of a user experience unlock that needs to happen. How far out are we from kind of a platform like Mirror emerging and speaking to people, kind of well outside the realm of crypto?
yeah, those are all great questions. So first, in terms of like the laws for guaranteeing, yeah. So the framework that I like to think about is the Howey test, and so that's basically this framework that's been published by the SEC and kind of dictates what should be deemed a security or not. And I think it's something like, I forget the exact points, but it's basically you expect it's reliant on like one organization or one group of people, and it's something around like you you give them direct financial access, and I forget what the exact points are, but I think that the key is that there's a few ways to that we're kind of thinking about it. And I think that right now the way it works is that we don't guarantee like, hey, you're going to get this percentage, you're going to get this. The way that our experiments have run so far is that all the funds from NFT sales. So if you do a crowdfund, basically the exchange is if you contribute ETH to the crowdfund, in exchange you get an ERC20 token. And so for our most recent crowdfund, it was for this newsletter called The Generalist. And so people would contribute ETH and then they receive Generalist. And so then in a week, he's going to mint an NFT, which is this essay for his S1 report on Coinbase. And so the funds or the revenue from that NFT are going to go to a treasury. And so say that he sells it for $10,000 worth of ETH. And so that $10,000 is going to a treasury. And the way that people can redeem those ERC20 tokens is basically say that you get some ERC20 tokens from the crowdfund. You can basically exchange your ERC20 tokens for the ETH in the crowdfund. And that's not up to the person who did the crowdfund. It's up to the people that funded it. And so in a way, it's kind of like it's decentralized. It's up to the person to decide like whether they redeem it or not. And there's no like specific like rev share or like royalty stream from this. It's more so these funds go into a pool and the people that hold this token can decide when to redeem it. And so in that way, it's like autonomous, decentralized, people decide. And I think frankly, to be quite honest, it's like a lot of this stuff we're still trying to figure out. And it's like really complex. Like it tends to be every time I explain it, I'm like, there's like more things and I'm like, oh man, I'm not explaining that right, or it doesn't make sense. But quite frankly, I don't think there's a great answer yet. We still need to have these types of conversations around, what exactly should we call this? How should it be regulated and things of that nature?
Yeah. I know we're, we want to respect the 2 p.m. cutoff, and we haven't had a chance to get questions or thoughts from the audience. So I do want to let anyone who has questions unmute or share thoughts. And then, yeah, and Joris and Jess, you could also feel free to share thoughts.
I have a quick question to Patrick. So I think like what you're setting up with Mirror is fascinating in terms of actually getting people to participate. But how do you govern the quality of the people that get to participate and publish their views if they're not part of the crowd essentially that understands this space?
Yeah, yeah, it's a good question. That goes to Sarah's point earlier. So yeah, I think that right now with any sort of new technologies, there's kind of like trade-offs. And I think that at this point, the way we try and do it is a lot of the experiments we've run. Well, one way is through the right race, where you have this decentralized governance process instead of being something like, hey, the 4 people that work at Mirror get to just give their friends invites and just let them do it. And so there's also some improvements we could have because right now it's not really based on your writing ability. So that's something we do want to do where it's like, okay, let's do a version of the right race where you get voted in based off of a writing sample and nobody knows who this person was. And it's just a 250 word writing sample and you can see them and it's easy to filter them and see and basically vote people in based off of that. And we think that's one way of doing it. And so, yeah. And I also think that, yeah, being able to allow people that do have large audience and onboarding them and speak to their audience. And so we're trying to do something with, yeah, like filmmakers and people creating documentaries and artists instead of just like the normal like tech influencer type of people. But yeah, definitely open to suggestions as well.
Yeah, that's super cool because I saw that some people that get in don't really end up writing all that much, and I was wondering if we could actually read what they wrote and then vote on them.
100%. Yeah, that's a fantastic idea.
I had a question. So I helped fund the Mario Gabriele's thing that you were just talking about on the generalist, and I was just curious, like how much insight you guys have into the motivations of people like me who are funding it, because it seems like there's probably a number of them, right? Some are financial, some of them are like wanting to be connected and helping like patronize the author, and it seems important that you have that mix and that you have people who care about the person and they're not just trying to make money, because most of these probably they won't make money, at least not for a while. Just want to see how you're able to gather that feedback.
Yeah, I think that's a really good point. And I think that the short answer is that we haven't found a great way to gather feedback. I think there's something you could do with like on-chain analysis where you could see how many people are redeeming their tokens as soon as the NFT gets sold. But to your point, and we need to do a better job of explaining this, is that it's very, very hard to make your money back with some of these. And so for most of them, it's, yeah, you should not look at it as a financial investment necessarily, but more so as a form of patronage and as a form of saying, hey, I was able to fund this person's project, and we're thinking about creative ways to make that more legible. And so I really like Twitch in the way that they have like leaderboards and badges and statuses. So that's kind of another benefit of adding your Twitter account for the right race, because then from now on, whenever you contribute to a crowdfund, your Twitter profile picture shows up. And so we're trying to think of creative ways of creating this type of economic social graph where you can see what are all the projects you funded, how much did you fund, at what point in the project did you fund it, how long did you hold for, and things of that nature to kind of like make these sort of like patronage models more legible.
So we talked to lots of creators, lots of participants in crowdfunding and social tokens. We're also a big participant in all these things. And I think your overview is 100% right. There's definitely the financial upside. There's definitely the connection. So we saw James Young purchase Lee Jin's piece for probably close to $20,000. And I think that's really more of like, there's the messages in the transaction rather than the value of the piece necessarily. But I think, as Patrick is saying, it's these networks that are emerging. So we want to be early supporters of people that we see doing great work. I think like the next billion users that come into crypto are going to come through these trusted sources that are creators and artists and folks who've curated like the trust of an audience. And so tokens are going to represent this ownership graph or this partnership graph, whatever you want to call it. And I think there's going to be a ton of value in that in a number of different ways. And so I think most of us that are really active in the space are both trying to be good stewards and grow great projects through participating, but also see a lot of value in those networks and the graph that builds out around them.
Cool, thanks.
And also just a note on securities, I did share a piece in the chat that I think is a really great way. It explains how we look at social tokens and securities. And the thing I always say with any of the creators or people we work with is that you have to just be cool with living in a gray zone, because we don't have certainty within the crypto space generally, outside of maybe the Ethereum and Bitcoin regulations there. So it's just really important to understand that these are safer ways to do things based on a lot of smart legal people, but we still don't have precedent here. So.
Yeah, I think if we talk about all those legal aspects, obviously today it's pretty unclear on how the SEC would deal with all the social token on or NFTs. One of the major challenge that all the platforms that are issuing this type of security of token, sorry, will face is today. The way those tokens will be used, and the way people will start to communicate around the potential of those tokens, that's what will qualify those tokens. And depending on how some people will go on Twitter or on any other social network and talk about those tokens, that might means that some issuers won't have any issue because they are the tech issuer. But then all the creators that will start to consider that they can use that to finance themselves, they will be liable. They will take the risk. And I think that's one of the major challenges today, like how to make sure that all these people are well aware that when they start to issue this type of token, and the way they use it. And I know that you just point to Ruben a post from December or something like that, and basically anything that has a financial return will be considered as a security. So it's very, very important to make sure that everyone is well aware of what they are doing with that, and for the people that put money on it, like what they are buying also. That's the major challenge, and I guess that this will be solved in the next 6 months, because so many people right now are talking about that, starting to using it, and it's becoming mainstream. So like anything that becomes mainstream, you know, we'll always find a way. I think it's a matter of time before that people will be more mature on that, and probably several years before that the SEC will give a clear overview of how they deal with it. And that, I think I cut you when I started to talk. Sorry.
No worries at all. I think there was also a question in the chat, so I don't want to jump the line. I know David had some audio issues, so I'll read out his question and then I'll ask mine. So David asked, his audio is bad. He's asking, as curious, how should founders think about preparing for a social token crowdfunding strategy? Any useful frameworks of ways to think about it? Thanks.
So I think it's really important to not look at social tokens as a way of generating funds for your community. This is not, do not go and sell tokens. We do not want 2017 ICO land to come into communities. This is not a good idea. Do not do it. And so beyond that, I think it's about, crowdfunding separately, crowdfunding through a Patreon, crowdfunding through maybe something like what Mir's standing up, though I think there's still open questions around how to do that safely. So we look at, go build a strong community, reward your community for the work and for being there, for the outputs that they're creating within that community. And then, there's a separation, and, the open nature of these things kind of can allow markets to develop rather naturally there. So yeah, really important to separate those two things. Do not go and sell tokens, I guess, is the core lesson here.
Yeah, no, 100%. The way that I like to look at it is, tokens are really just like an accelerant. It's kind of like when you're an early stage startup, and after you have product market fit, you raise venture capital or maybe outside funding, can accelerate growth by hiring more people and having more for paid marketing, things like that. And so, yeah, I don't think it's going to substitute for like genuine connections. And I think Jess is probably one of the best thinkers about how to actually like strategize and building a community and then layering on a token in a really smart way.
My question was similar, and I was really curious to learn more about kind of the emergent business models that you're seeing. I've been seeing a lot of VC-backed platforms in the space, and I'm curious how that aligns with kind of the incentives that a lot of these platforms have. So if you could speak more to like the emergent business models that you're seeing.
Yeah, there's a group chat that I'm in right now that is talking about this specific thing, and I think there's a lot of complications when you think about standing up a token, whether it's for a DeFi protocol or for communities. And I think what you'll see is a lot of teams realizing that this is really early and needing to be capitalized for the long run, and whether they have a trading token or not, making sure that those partners they work with have a long-term point of view is seen as very valuable. So VCs have a long-term point of view. On the opposite side, there's community involvement and wanting to make sure that there's ownership spread through the people who are creating value there. And there's more regulation challenges on that side. So I think you're seeing creators and founders trying to thread a needle here that's moving and isn't solidly grounded anywhere. So I think we've seen like quite a whiplash in response to fair launch versus VC launched, and then well, what is actually fair launch if people who have a lot of capital can still participate at a higher and earn more than small individuals. And I actually think like the tools that Mir's building, like the right race, is probably the most exciting curation onboarding tool that I've seen in the space so far, and that it's sure, there's a lot of challenges with it, but I think we can't deal with absolutes here. This is a big step in trying to figure out how communities can self-regulate who they bring on board, in whatever terms they feel is appropriate. So I think there's some interesting ways that we'll be able to at least embed deeper ownership and distribution of that ownership through these projects moving forward. I think the most interesting business models that I've seen are these like, take a look at what tech optimists are doing on Twitter. It's just a Telegram group that from that has emerged a bunch of NFT sales, and there's this token network that's kind of building around it. They don't have a fungible token yet, but you could see that path being pretty clear to them. But they're collectively generating revenue on chain, and I think that's like the most exciting piece here. Is you sort of generate revenue on chain, have some representation and ownership there, layer on some light governance, and let's see where it goes.
Yeah, one of the components also in all the VC investment on all those protocols, crypto projects, is also that they could completely missed the ICO craze. They were not there when the good ICOs started, and when they arrive on the scammy one, they obviously didn't capture any value at that time. So today they are well more aware of all the things that are done. There's lots of crypto analysts there, crypto Twitter, mostly are VCs, and at the end, when they decide to invest in one of those company, they always do it in a way so that they capture the capital at one point. They capture some involvement in the governance, and then that's only when the project is mature enough that most of the time we start to see the community being able to access that. That's probably the fastest way to do a 10x or 100x as well. So that's a pretty good investment for all those funds, obviously. Um, I think what would worse it would be to make sure that anyone could piggyback on those investment at the same term at the same time, without maybe capturing any governance, but making sure that the financial upside would be fully aligned. And I guess that's one of the major challenge for the next 2 years and all the protocols that we start. But we also see that in the VC world, there are more and more operators that launch their phone. They are more and more able to invest super fast, smaller check, without the need of big ownership and all the things. So those type of fund will be probably a great way also to finance many of those projects, by multiplying those type of tech. And we see it at Fairmint right now. We just raised 1 million over the last 3 weeks since we reopened our offering. And we started to see, so it took us 7 months to raise 100K, 3 months to raise 800K, and literally 3 weeks to raise 1 million more. And the people that are investing are nonstop increasing the size of the check. And we want to make sure that you can have like so many people able to come and to piggyback on all the same terms, that anyone can get. Um, and I think that's what's happening right now on many of those projects.
Yeah, I do think what's part of what's interesting about what Fairmint is doing is that, as Patrick mentioned, with tokens, there are a lot of potential use cases that involve financial upside, access, governance, and Fairmint has taken the position that there's no governance involved. This is purely about sharing financial upside, and so there's just a level of simplicity there that's really interesting. I think, as Jess said, this space is so experimental and new that it'll probably take a little longer for us to kind of land at the right kind of experiments in the social token side.
Yeah, one of the beauty also on top of what you just said is as soon as you start to issue tokens like ERC20 type of token, you get a chance to complete financial upside type of token by a governance. You can always work on that, and I think it's very important to see what is done today to make sure that anyone can appropriate himself all the token, making sure that they can issue on top of financial upside some governance if they want to work on some type of contribution, reward, all those things. And that's why making equity programmable is just obvious. I mean, software ate the world. Why not eat the equity and the securities? So that's coming. Obviously, it's more difficult than issuing social money, currencies, making a simple token sale. But as soon as you start to deal with all the hurdles, and to be honest, today, with just what happened this week with the new crowdfunding exemption that has been modified, I think two major points are absolutely genius in the current regulatory framework. First one is that the crowdfunding now for non-accredited investor is at 5 million, but also one of the major issue before was the threshold of private company owning being owned by maximum 2,000 shareholder. That has been completely changed due to the new crowdfunding. With the SPV that is accepted, that means that you can have 10,000 non-accredited investor that can go through just one line of a crowd SPV on your cap table. And that is game changer because that gives the opportunity to private company to raise from non-accredited investor from day one. And in the same time, same term, people will be able to raise from accredited investor from VCs on a private type of offering. But those people, they will end with the same class of assets. And that's a major shift. And as soon as you start to eat the silver bullet of, securities, though, you go in a world where there is certainty. And I agree on the fact that it's super cool to see all the things that are happening now, but as soon as you start to add MetaMask in the equation, then you need to deal with a pretty small market. It's getting bigger and bigger, and that's awesome. But still, it will take time before that my grandmother would get a MetaMask. But right now she has a credit card, and if she can go super easily and get the upside of the cool website where she buys her specialized clothes, she's super happy. And I think that's what crypto is bringing to the world.
Like I'm a huge fan of what you guys have been building at Fairmint. I've been following for a long time, and I think your points there are all 100%. I also think that crypto and tokens are amazing, and they're enabling a whole level of permissionless participation in digital organizations that, you know, the regulations and sort of securities laws as right now are limiting for good or bad, right? Like I think you can make an argument, and it's good to see the improvements on the Reg A crowdfunding, though it's still an extremely expensive process to go through, and I would expect that to change. But the piece that we're kind of missing, if you think about, just trying to say, well, we need to get everybody into a crypto-like experience, and credit cards are important, and nobody's going to use MetaMask, is just this entire world of composability and new financial tools and just innovation that's happening in the crypto space. And so this is, without a doubt in my mind, the future is these brilliant human beings building things that just get bolted together to create other brilliant things. And that just doesn't happen in the Web 2 world. It doesn't happen in the existing corporate world, and it's not going to happen that way. And so these new digital organizations are where that innovation is going to be created and captured. And the barrier is really low. The barrier is buying some Ethereum and setting up a MetaMask. And yes, there is a barrier there, but the learning curve is steep, but the plateau is beautiful and warm and exciting. And I think our job is to get people up to that plateau, not to bring the plateau down to a point where it removes all the innovation and usefulness that comes from the innovation that's happening in DeFi and in community composability and in interesting distribution and curation games, all these things that are really cutting edge. That getting into the crypto space is probably one of the most valuable things we can do for individuals. I think there's just so much legitimate earning potential, but also just innovation that's coming down that way. And so I am a staunch token supporter, and that doesn't, and I go back to my initial point of saying I love what you guys are doing, and we need to push both these things forward. I see these two worlds just like trains running down the tracks. More opportunities we have to crash them together and run on the same tracks, the better it's going to happen eventually. We just got to keep hustling.
Yeah, and to both of those points, yeah, no, I love these conversations where we have like different perspectives, and of course, there's no right answer, and we're building it as we go. That's kind of one of the most exciting parts. And like a bit more on my background. So I started off at a DeFi startup about a year ago. And about 7 months in, I left because I was like just jaded with the experience of people just buying tokens to sell them and speculate on them. And I was like, I got into crypto because of these ideas of decentralization and permissionless access and all that stuff. But they got really, just disconcerting when people are just shilling tokens and just trying to get yield and earn money. And so I ended up leaving and decided to work on stuff in the creator economy and building tools. But then about a couple of weeks ago, I just realized that, those are my interests. There's crypto and there's creator economy. And I saw what was going on in crypto. I saw what was going on with creator economy. Also saw the crazy stuff happening in DeFi, and was like, there's got to be like some way to make this work in a way that's not scamming, like some stuff tends to be, but also has the power of these permissionless composable platforms. And they believe that James Young, and like Jess earlier, he's the one who ended up winning the bid for Legion's artwork or NFT. And he said that he bid as a form of activism. He said, hey, I bid on this because I want to show that I value this idea. And the fact that I paid this much for it means it's worth this much. And it's very hard to show that I really value these ideas. And that's kind of how I view me working in crypto and spending my time working on these types of products, where it's kind of like a form of activism, where it's like, I think this is how the world should be. And there is a way that the world is. And do I think the DeFi, there's some stuff in DeFi that is sketchy, and in crypto that is sketchy? Do I think there needs to be some sort of guardrails or something? It's like 100%. But being able to kind of start from first principles, as they say, and kind of like completely just like kind of throw out a lot of the previous assumptions and build things from scratch, I think is probably one of the most exciting things about crypto. And I think there's going to be a lot of bumps along the way, but being able to kind of be there building it and deciding it with a bunch of awesome people, I think is, for me, kind of what has attracted me and back into crypto.
I empathize a lot with that struggle. I mean, I've spent my entire career basically working for the Web 2.0 platforms, for Pinterest most recently, for a bunch of these ad tech companies that were buying mostly Facebook inventory. And just like figuring like the struggle of like trying to support all the good things that were happening, but also seeing the downsides. For me now, I'm finding that I'm like much more interested in making the future happen And I think where the future is like, outside of the platforms, helping creators actually more directly monetize, kind of the stuff that Sari was talking about more in the beginning, right? Like the merging, not crypto for the sake of speculation, but crypto for the sake of involvement and giving ownership and giving upside to the people who are actually creating value on these platforms. Which is clearly, there's some being created within the company, but the vast majority of it is unmonetized, being created by the people who are actually uploading the content. There's no Pinterest without the pinners. There's no Facebook without people uploading pictures and changing their relationship status, and it's just been they've been underappreciated for so long.
Come hang out at C Club, Sean. Come hang out. We're warm, friendly, welcoming human beings.
Yeah, I connected with you on Twitter. I would love to chat further with you.
I need to hop off, guys, but I really appreciate the conversation, Sari, and
thank you for joining
Patrick
us.
and Joris.
Thank
Right
you
on.
for
Thanks,
joining us,
guys.
Jess, and for the wonderful work you're doing. Yeah, I realize we're way past time. So yeah, I mean, I'll stick around, but Joris, Patrick, if you have to bounce, thank you guys so much. Yeah, lots to think of here. Yeah, one thought I had is on the Gumroad crowd fund, Joris in particular, with Fairmint, I can always log on and see what the value of a fair is. There's this kind of live real-time market, whereas Gumroad raised money and they're kind of off to the races, back to work, heads down, and the value is not fluctuating. And I'm curious, you know, I don't, what are the broader implications of that when you have this kind of live market to maintain?
Well,
Just wanted to say that do have to hop off, but I want to say thank you for having me. And yeah, if anybody wants to talk more about any of these ideas, like feel free to reach out.
Thanks, Patrick.
All right, bye everyone.
bye. Yeah, so to answer on Gumroad, I think what Sally did was awesome. Making sure that all the people would be among the first, getting the 5 million news threshold of the SEC. That was a great marketing for sure. I think what has been lost is probably the 20 to 100 million upside for the entire community. Because what happened here is basically not having a fair market value for a while. Well, it means that they could have started at 20 thanks to technology like ours and allow everyone push the valuation to the 100 million, raising 5 million, for example. They decided to start at 100 million based on the terms that Naval decided to with Sahil. So I mean, I think it's awesome, but in another way, it's like you can start to play with us, but at 100 million, 100 million valuation. So I think that's the major hurdle that I see in such a move. I also consider that, as soon as you start campaigning, and at the end of the campaign you prepare a wait list, you are also losing the experience that you could offer with a continuous type of offering, where all those people would have been able to literally interact with the valuation, with the upside that they could generate, where maybe they could have raised 20 million and push the valuation at 150 or 200 million, where basically the market would have been playing. Here, it's like there were terms, and these are the terms. You are early, that's fine. You are too late, well, you are too late. And then you feel like all the community at Revolut, for example, that missed the crowdfunding when they did it, and that years after are looking for a way to access that, but it's too late in years. And that's what we are solving at Fairmint. How does it work? Well, it's very simple. I mean, as soon as you have a minimum percentage of equity allocated to your offering on Fairmint, I mean, using Fairmint technology, well, that means that you can, by extrapolation, calculate what would be the valuation of the company. And anytime someone come and invest, it has an impact because the only arbitrage for the investor is the valuation. And so making it so simple, it means that your 490 valuation report can be calculated based on the fair market value. So it solves all the issue that exists today with options, because like if tomorrow Gumroad decide to give options, what will be the strike price? What will be the valuation at one moment? So it raises many questions. I just need to applaud on the fact that he was bullish enough to do that, and that's already a big step. I don't know if many people would have been early adopter on these terms like Sahil did, and honestly, it's a hat trick for that.
Joris, and I'm curious, from the early experiments that you've done, are they mostly people interested in fundraising or in rewarding contributors, or both?
Yeah, well, right now we see really both on 80% of the inbounds, and 10% are coming from fund managers. So for them, it's only fundraising. But yeah, most of the companies, one of the things that we push back is really like making sure that depending on the stage of the company, um, they are not considering our tool as a way to build the community. And that's what Jess or Patrick were saying earlier. Like, um, we are a tool to compensate people, to make sure that at one point, the action for the community will be rewarded. Um, if you come expecting that thanks to the reward you will build a community, then you're just missing the point, because the product will make the community, the mission statement, the founding team. And what we wanted to make sure with this tool was that the people would be that first, that the founder would raise based on their execution. So the more you execute, the more you ship, the better, and the stronger the community obviously behind you. And that's when you can turn this community into owner by investing or by starting to do actions. I mean, at Fairmint, we never had as many people knocking at the door now to say, hey, how can we help? And this is awesome, but obviously it happens 1 year after we started to issue the dollar fare, and 2 years and a half after we started the company. And we see this acceleration um, at the same time as we see the check from investor getting bigger and bigger. And it happens exactly the same for our customers. I have a great example of customer that launched 3 or 4 weeks ago now. Um, they had, it was pretty hard for them to raise funds. They wanted to do a bridge, and when they decided to launch their cafe offering, the only thing that they did was to say to the community of users and customers that they had. And literally, that was a teasing mail on Friday. And on Sunday evening, like literally a few hours after launching, they started to receive check from users, from their customers, the one that pay for the service. And they didn't know them except by the connection of, the business connection. And they started to receive 100K, 150, 200, 225, and they raised more without pitching anyone, without spending any minute on a deck. So all the work that they spend over 6 months, 8 months before discussing with VC, trying to create some signal, without that, they had a signal from their community saying, hey, you know what, you're a tool, we like it, and we want it to be part of our life, so we will finance it. Um, and, um, and now, after several weeks of distraction from the community, they start to see investors, professional investor, getting back and say, hey, can we discuss again? But the valuation is not the same. So the thing is that you can turn an offering like that into signal, but this signal will come from your business, from the way you execute, from the way you deal with your community of customers, users, partners, to make sure that those people will be able to create like a grassroots movement behind you, showing to the professional investors that maybe they should just invest in this company. And that is one of the major game changer several months after this launch of customers. And we also start to work with founders on like educating them, making sure that they have the right vision of running their offering. It's not a campaign, so it's not a sprint, it's a marathon. They need to focus and remain laser focused on their business, define some KPIs, some metrics, so that they can communicate more publicly with just those KPIs, without shilling forecast and decks and things. Um, and, and and that's a really novel way of getting financing, super far from the traditional fundraising campaign that we see, where the funding portal are pushing you to spend 30 to 50% of your fundraising into ads at Google or Facebook to make sure that you will train enough traffic to them, so that you will hit the goal, the minimum goal, 100% super fast, and then you will start to gamify your campaign. But at the end, what people want is just an access when they arrive, when they discover the company, and maybe they will need 1 year to be turned into owner, because they will need to monitor things. Um, but that's fine. They can come, like Bitcoin's 1 year ago was at 3,000, and lots of people were running away from Bitcoin, and now that it's at 50 or more, everyone wants in. So the only thing is like feeling ready to invest in this type of private companies. And to make that happen, you need to have an access that is always open. And that's not the case in the old way of fundraising.
Totally. Thank you, Joris. Appreciate it. Yeah, for all those still hanging out. Any questions for Joris? Thoughts, comments? Would love to hear.
If you wanna ping me anyway at any time on Telegram, I will drop my Telegram in the chat. And if you have any questions, like, don't hesitate. I mean, obviously, we are now working on making sure that the onboarding on Fairmint will be more and more automated. And the goal is really like, yeah, to turn our technology into what will power most of the private companies, um, almost from day one. Like, it could be like you incorporate and you decide to check the box to run a cafe offering and to put 10% of your equity and use this 10% to create a market around your company, but also compensate anyone that would be working for the company, that would provide the company with a service, and giving a very smooth experience of that, without being the middleman, without being the portal, but by literally deploying for each of those company their own funding portal on their own website, making sure that it's fully branded and that the entire connection with the community will remain. Imagine if Airbnb would have done that rather than to go on a stock exchange. They could have run their own IPO on their own website, and that's the vision that we have at Fairmint. We were expecting from Coinbase to do that. That was our secret hope. But at the end, they decided to run through the Nasdaq or NYSE. I don't remember which one. Um, well, that's kind of pity, because they could have issued their dollar coin directly on their exchange, targeting the 36 million of users that they have, knowing most of them are accredited due to what they are holding on their wallets, and all those details. That could have been a massive social movement that they could have launch and create. But I think it will come in the next 2 years probably. And our vision at Permit is really like making sure that in 3 to 5 years we start to see SPAC able to exit all those great companies directly on their website, without the need of going through intermediaries like investment bankers and all those things. That's basically the vision that we have, that loop completely what I was saying at the beginning with the decentralization, democratization and decentralization of the world, of the wealth, and making sure that we can counteract inequality this way.
Amazing. Joris, can't thank you enough for all of your full 90 minutes here with us today.
Pleasure.
Yeah, I know I speak on behalf of everyone when I say that Fairmint is one of the more interesting products in the market today, and we are all rooting for your success. Yeah, so thank you so much for everyone that stuck around to the end. Any kind of questions, thoughts, I'm available on email, and yeah, I'm excited to keep this conversation alive.
Thank you, Sari. Thank you, guys. Bye bye.